Have you ever heard someone say, "I only invest in stocks that pay dividends"? It's a super common strategy. People love getting that regular cash payout. But what if I told you that, in a perfect world, whether a company pays a dividend or not makes absolutely no difference to its value? It sounds crazy, right? This is the core idea behind the Dividend Irrelevance Theory, famously proposed by economists Merton Miller and Franco Modigliani. Stick with me, because understanding this will change how you think about investing. So what's the big idea? Miller and Modigliani argued that a company's value is determined solely by its earning power and its investment decisions, not by how it distributes its profits. Think of it like a pizza. The value of the pizza is in the whole thing, right? How you slice it, whether into 8 small pieces or 4 large ones, doesn't change the total amount of pizza you have. In this analogy, the pizza is the company's value, and the slices are the dividends. Let's break it down with a simple example. Imagine a company, let's call it Innovate Corp. It has $1,000 in cash and decides to pay out a $1 dividend per share for its 1,000 shares. After paying the dividend, the company's value immediately drops by $1,000 because that cash is now gone from its books. The stock price will adjust downwards to reflect this. So, as an investor, you get $1 in cash, but the value of your stock holding drops by $1. Your total wealth, the cash in your hand plus the value of your stock, remains exactly the same. You haven't gained or lost anything. Now let's consider the alternative. What if Innovate Corp decides not to pay a dividend and instead keeps the $1,000 to reinvest in a profitable project? If the project is good, it will increase the company's future earnings and, therefore, its stock price. Your shares will become more valuable over time. If you need cash, you can simply sell a small portion of your shares to create a homemade dividend. The end result on your total wealth is the same as if the company had paid you a dividend directly. Either the company gives you cash and its value drops, or it keeps the cash to grow, and you can sell some shares for cash later. The theory says these two scenarios are financially equivalent for the investor. Of course, you might be thinking, but wait, the real world isn't that simple, and you'd be absolutely right. The dividend irrelevance theory relies on some very strong assumptions, a bit like a physics experiment in a perfect vacuum. It assumes there are no taxes, no transaction costs for buying or selling stocks, and that all investors have access to the same information. It also assumes that the company's investment decisions are fixed and not influenced by its dividend policy. In reality, these things matter a lot. Taxes are a huge one. In many countries, dividends are taxed differently than capital gains from selling stocks. If dividends are taxed at a higher rate, investors might prefer companies that reinvest their earnings to grow the stock price instead. Transaction costs also play a role. If it costs you money every time you sell shares to create a homemade dividend, then a regular free dividend from the company starts to look much more attractive. Another key factor is what we call information signaling. When a company consistently pays or increases its dividends, it sends a powerful signal to the market. It suggests that management is confident about future earnings and that the business is stable and healthy. A sudden dividend cut, on the other hand, can signal trouble ahead and cause investors to panic. This signaling effect can absolutely influence a stock's price, something the pure theory doesn't account for. So, is the dividend irrelevance theory useless? Not at all. It's a powerful baseline that helps us understand the fundamental drivers of a company's value. It forces us to ask the right questions. Instead of just asking, does this stock pay a dividend? We should ask, what is this company doing with its profits? Is it reinvesting them in high-growth projects, or is returning cash to shareholders the most efficient use of that capital? The theory teaches us that a company's ability to generate earnings is what truly matters. How it slices the pie is secondary. It provides a crucial foundation for more complex, real-world investment analysis. Thank you so much for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into the world of finance. Let me know in the comments what you think. Are dividends important to your investment strategy? See you in the next video.